March 6, 2009. The United States stock market hits a 10-year low when the Dow Jones Industrial Average falls to 6,507, marking the low point of a 2-year time period where the stock market dropped 54%. The question isn't how this happened, it is why. We know how the economy collapsed, but what many do not know is why this happened. What reform in finance caused such an adverse reaction? The cause behind the financial collapse of 2008 is revolutionary reform in financial policy. The government, whose job it is to protect a prosperous way of life for its citizens, instead gave in to the demands of the banks. The reaction was the largest recession since 1933, 75 years prior. The issue begins with regulatory changes in reaction to the Great Depression. The Glass-Steagall Act, financial reform passed in 1933, stated that all bank deposits are insured by the Federal Deposit Insurance Corporation, or FDIC, that the Federal Reserve has the power to regulate interest rates in savings accounts, and more importantly, that retail banks, banks taking deposits, and investment banks, who make risky investments with clients' money, may not merge. This was reform that was needed in order to prevent another depression. The bill successfully accomplished this. However, as time went on, financial regulation loosened. In 1997, the United States was in excellent financial shape in the midst of Bill Clinton's second term. The economy peaked to an all-time high in July of 1997, unemployment had dropped below 5% for the first time since 1972, and the country was left with a budget surplus.
Reform begins in 1998. Citibank merged with Travelers Insurance, violating the separation provision that was the main reform written in the Glass-Steagall Act that was passed after the Great Depression. Thus begins the merger of banks and the formation of Citigroup. On November 12, 1999, the separation provision in the Glass-Steagall Act was permanently repealed with the financial reform detailed in the Financial Services Modernization Act. This bill was the reaction to Citigroup and the revolutionary change sponsored by 3 Republicans, Senator Phil Gramm and Representatives Jim Leach and Thomas Bliley. Following the Financial Services Modernization Act, the line between retail and investment banking was non-existent, meaning that banks could now take deposits from customers, give loans, and use the money to make risky investments in stocks and derivatives. This was a foreseen and intended reaction. What was not intended was this. Due to reform commuting risk, banks no longer had to deliberate over who they gave loans and mortgages to. Under the old system, retail banks and lenders giving mortgages had to be very careful because one bad mortgage would be on the books for years, and the losses from such a mistake could cripple the bank. This led to numerous credit checks, high down payments, and hard limits on who could receive a mortgage or loan. In a world where risk is paramount, it was placed firmly on partners and executives in the bank. Now, post-reform, the risk of the retail bank was commuted to the shareholders of the investment banks that now held these mortgages. There were still regulations in place to control trading leverage, meaning that for these investors there was a certain degree of safety, as banks could not grossly overspend. What was missing was a set of regulations in place to control who could take out a loan. This is the deregulatory aspect of the Financial Services Modernization Act that caused Wall Street to react by exploiting the new reform to spin profits thought to be impossible. So how did these profits increase? To understand this, one must understand how banks profit from mortgages. Money from mortgages is made from the fees and the processing charges on the front end of any loan and from the interest rates charged on that loan. An ideal mortgage for a bank used to be a safe mortgage, one given that had a failure rate close to 0. While the lower interest rates on a mortgage to someone with good credit would limit profits, their high probability of paying off a loan would also limit loss, meaning that the bank would make low-risk profits. It was assumed as of 1999 that this would stay constant. How could a risky loan, one likely to fail, possibly be better for a bank than a sure bet? Truth is, this assumption was, at its core, correct. For the long-term health of the bank, safe loans are always best. But, reacting to financial modernization reform, these were not the most profitable for those giving the loans. The most profitable loans for banks, short-term, and subsequently the worst for the bank itself, were called subprime loans. A subprime loan is defined as a loan given to a borrower with a poor or low credit rating. These loans have high interest rates and require the borrower to accept less favorable terms than someone with a high credit score. These loans make banks more money due to the higher interest rate, but have a high failure rate due to the limited credibility of the borrower. The occurrence of these loans prior to 1999 was 5% of all loans, but in reaction to the reform detailed in the Financial Services Modernization Act, the number of these loans given substantially increased to 20% of all loans. What all this meant, on the surface, was that more Americans could own houses and banks were making more money. Unfortunately, the underlying truth of this was that more money was being borrowed by people who in the past would not have and should not have been able to borrow it. This meant the banks had more potentially toxic assets on their hands than ever before, and millions of people owned houses they couldn't afford. The huge number of subprime loans given led to what economists call a bubble, meaning growth is being created that can only last for a finite period before eventually coming to a swift end. In reality, a drop in the economy of 3% would have caused a crippling reaction. The majority of subprime loans would be sent into default, meaning the holders of the loans would be unable to meet scheduled payments. If this were to happen, banks would react by foreclosing on the property, seizing it, and putting it up for sale. This would hurt the banks by forcing them to have real estate holdings they had to sell quickly. Property values across the country would plummet as vacant houses abounded in America's neighborhoods. The failure of these loans would cause negative reaction in one last realm, the single most important aspect of this crisis, the derivatives market. Specifically, collateralized debt obligations, various types of loans made into complex asset-backed securities. These CDOs allowed banks to reduce the liability they have if loans are to fail, raise capital, and allow others to share the bank's risk as well as profit. CDOs are rated by 3 rating agencies, Moody's, Fitch, and Standard & Poor's, who are paid by the investment banks to determine the risk involved in a certain investment. These agencies are paid more for every CDO they rate and thus failed to diligently provide ratings, preferring to maximize AAA ratings and therefore maximize profit. CDOs are then given an interest rate that is inversely proportional to their rating. A high AAA rating is almost no chance of failure and therefore receives a low interest rate, which limits what the investor can make off it while also limiting what they can lose. Conversely, a B CDO has a high interest rate due to its high risk. Just like any other asset, a CDO can be underwritten through a form of insurance, though one vastly different from standard insurance in that anyone can insure it. In contrast to a house, car, or boat where only the owner may insure it, derivatives can be insured by any speculator in the form of a credit default swap, or CDS. Normally, a holder of a CDS is simply hedging their bet on a derivative, paying a yearly premium to prevent loss. But, in the case of many of these subprime-backed CDOs, speculators would pay the insurance premium to enable themselves to get full valuation of the derivative when it failed. This system would work because the CDOs that were being insured were the very same ones that had been rated AAA, when in reality they are high-risk, poorly rated investments. This meant that for the holder of the CDS, the reaction was huge potential gain, since the investor risk was tiny and the return on investment could be huge, whereas the reaction would be fatal to the underwriter. In 2007, the culminating reactions started by the revolutionary financial reform and the Financial Services Modernization Act take their final form. As economic growth slowed naturally, millions defaulted on their home loans, sparking a rate of foreclosure never before seen in America. Once these loans were defaulted on, the CDOs made up of these loans, many supposedly AAA rated, failed. The failure of these loans halted the subprime market as lenders had nowhere to send their subprime loans because no investment banks could sell them. This forced many lenders who were holding subprime mortgages to fail. This also ruined banks, even driving Lehman Brothers, a top investment firm since 1850, to failure. A chain reaction trickled down to the shareholders of these banks as well, causing their investments to drop over 50%, sometimes even becoming a complete loss. In addition, it crippled those investors holding subprime-backed CDOs. These investors lost most, if not all, of the money they had invested. This, in turn, caused the stock market to drop 54% over the course of the next 2 years, starting a global recession, a reaction we have yet to escape from. Reciprocating the losses felt by investors, the corporations underwriting these CDOs also experienced massive losses. AIG didn't believe these bonds could fail, and therefore did not have enough capital to pay CDS holders. AIG would have failed had the United States government not reacted with a revolutionary $182 billion cash infusion in which they paid all CDS debts in full while taking partial ownership of AIG. What this meant was that the only investors who didn't lose money were those holding credit default swaps for the very CDOs that failed. The collapse of the banks forced the hand of the federal government in an unprecedented manner. Reacting to the recession, the American taxpayers were forced to foot a bill of approximately $11 trillion in order to stimulate the economy, as well as bailing out other corporations such as Bank of America, who bought out a defunct Merrill Lynch, Bear Stearns, and Citigroup, to prevent further collapse of the economy. All of these effects and their ultimate reaction, the current global recession, were the result of much reform spanning a long period of time. However, all reactions have a cause, and the catalyst behind the global financial crisis, the reform that marked the beginning of the end, was the Financial Services Modernization Act. This legislation created a revolutionary change in the banking industry, loosening regulation and dooming the economy through the subprime mortgage crisis. We are left in a world reacting to this reform by cutting use of the American dollar, causing a revolutionary change in worldwide monetary policy. Our country holds a responsibility for the global recession. Financial reform detailed in the Financial Services Modernization Act of 1999 is to blame.